Welcome to the NAIFA webinar series, providing you with timely information and training each month on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. This month, we are presenting Retirement Plans 101. With me today are Max Colliette and Nick Pelivita. As President of National Pension Partners, Max brings more than 30 years of retirement planning experience to the team. He also owns Intermountain Financial Education, which provides licensed continuing education to CPAs, insurance producers, and other financial professionals. In addition, Max is President and Managing Principal of One Financial Advisors, a comprehensive financial services firm helping clients to maximize their wealth, retirement security, and financial protection. Max has extensive experience working with individuals, business owners, and executives, as well as managing the training and development of other financial professionals. I also would like to add that for over 20 years, Max has been a national presenter of CE events for both NAIFA associations and CPA associations. And Nick Pelivita is CEO of National Pension Partners, Adjunct Professor of the Graduate Tax Program at Northeastern University, and a member of the Florida Bar and American Bar Association. He is admitted to practice in the state of Florida, the U.S. Tax Court, the Ninth Circuit Court of Appeals, the 11th Circuit Court of Appeals, and the Supreme Court of the United States. His wealth of knowledge and experience in the fields of advanced tax, estate, and pension planning span more than 30 years, and he has presented continuing education programs and seminars across the country. Nick has also been widely published, including the definitive guide, Defined Benefit Pension Plans, the Complete Handbook. Today, Max will go in depth discussing the various types of retirement plans that are available, including fully insured pension plans, 401ks, and defined benefit plans. And Max will also cover the pertinent tax considerations that you should be aware of. Nick will serve as a resource during the question and answer session. During the presentation and the question and answer session, you may type your questions in the question box on the right side of your screen. Questions will be answered during the question and answer session at the end of the program. So let's begin. Max, welcome to the webinar.
Thanks for having me. This is a fun thing to talk about that Nick and I get heavily involved in this time of year. We do a lot of pension plans, and this seems to be the season for selling these. What I'd like to talk to you about in general is pension plans, and especially a very fast-growing segment of the pension marketplace, which is the micro-defined benefit market. I actually had a meeting yesterday with an attorney who said, well, aren't DB plans sort of dead? And I said, except in the micro market. And as we went through the whole discussion, he said, wow, I see this, and it has a lot of potential. So why is this happening? Well, basically, we have to recognize that we have a lot of baby boomers out there. And what's happening with the baby boomers in their marketplace is they're struggling because of historically low savings rates. Retirement accounts have been ravaged by market slides the last decade. As my brother-in-law said to me not long ago, a few years ago, my 401k became a 201k. We also have some changes that have taken place in Congress. They passed some significant changes in 2001 that were designed to help people build and fortify their nest egg in retirement. Then in 2006, with the Pension Protection Act being passed, they added the ability to combine a defined benefit with a defined contribution plan. So among all these changes were also changes in rules that clarified and transformed what was the old 412I program into what today is called the 412E3, or fully insured defined benefit plan. And it turned it into, frankly, a terrific strategy and way for older and higher income businesses and professionals to shelter unprecedented amounts of retirement accounts and do it, frankly, in a relatively short period of time. Now, the question that always comes up is, why do professionals and business owners need to have qualified plans? Well, it's simple. Tax qualified plans help those successful professionals and business owners meet a variety of needs. One, of course, is the old recruit, retain, and reward employees. And that's important in today's world as the business market tightens up, as well as reducing their own tax burden. You know, in today's world, with the increases that have happened with taxes in the last several years, you know, protecting clients and families from the labor or load of taxes has become more important. Also, they look at how do we protect our families and the quality of life by sheltering assets from legal and liability concerns and creditors. And that's part of what pension plans will do. And I kind of sometimes jokingly refer to O.J. Simpson as my poster child for that, because he has millions of dollars in judgments against him, yet has a very nice pension plan which comes from the NFL each year. You know, in addition, the tax deduction for contributions can result in a reduced accumulated earnings and the exposure to the accumulated earning tax for clients, as well as clients who are in that higher tax bracket not having to pay the Affordable Health Care Act, as some refer to it as the Obamacare surcharge, but that tax that comes about, and as well as PAT Ps and some other issues we'll discuss a little bit later. Now, there's some questions as you get into this market that you need to consider, you know, because in today's world we need to discuss this whole thing in relationship to the micro DB plans, which again, as I said, you know, it's been growing in popularity, and there's some reasons. So here's what you need to start with. Ask yourself, is your client's retirement account underfunded? You know, we know it used to be, when I came into business years ago, you could say, well, as long as a client has 6% that they can withdraw from their account and that 6% covers their expenses, you're good. That 6%'s gone out the window and it went to 4%. Now many advisors are publishing facts that say that 3 or 3.5% maybe is more appropriate. So clients need more set aside for retirement, and they need more safe money, because as they get older, they can't afford the whipsaws that the market hits them with. You know, another question is, do your clients need to reduce their taxable income significantly? Just this week we met with a dental professional, an oral surgeon, and he said, you know, I paid off all my debts and paid off all my student loans and paid off my practice, and wow, I paid a lot of taxes last year. And so he's sitting there and he's saying, you know, I was about a 57% tax rate when you put it all together. How can I reduce my taxes? I've read online and read some things that say that pension plans might help me. How can I do it? And that's an important thing to a lot of clients, is how do they reduce their taxes? So would your clients like to dramatically increase their tax-deductible retirement savings? And like I said to this dentist, would you rather put money aside for your own retirement or put money aside for the federal government employees? And of course, we all know what that answer was. Would you like your clients to provide, or would your clients like to provide substantial survivor benefits to their beneficiaries? There's a lot of studies out there that refer to this. In fact, there is a Dr. Fowl with the American College that has several papers published that talks about the way to maximize retirement income is a combination of, you know, insurance contracts, annuities, and investments. It's not annuities alone, it's not life insurance alone, it's not investments alone, but the combination of those contracts can provide a stronger retirement income with more security. So the other issue is, have your clients been hurt by the market declines? Does that hurt their retirement nest egg? And I just love the quote my brother-in-law hit me with, where he said, my 401k became a 201k. And I think there are people out there that feel that as they look at their retirement accounts the last few years, and I'm amazed at how many of the clients look at their retirement accounts so often today that never did before. So here's the question: qualified retirement plans, what can they do? They can provide a stable source of retirement, disability, and/or death benefits. That's an important thing to think about. And qualified retirement plans are typically set up by employers to provide for not only their employees, but also for themselves, with the benefit for retirement and disability and death. And these plans are referred to as qualified plans. Now why is a qualified plan important? Because it receives tax-favored treatment. These plans have specific requirements to receive this favorable tax treatment under the Internal Revenue Service Code. It's also important to understand that individuals that have individual SEPs or simple plans. Yes, those are employer-sponsored plans, but under the code, they are truly IRAs, and they're not really qualified plans. So yes, they do have some favorable tax treatment, but they may not always be the best thing for the employer to invest in because of the benefits they have to provide to employees. And we'll talk about that in a few minutes as well. This favorable tax treatment also includes things like tax-deductible contributions for the employers, for self-employed individuals. It's the tax-deferred growth we're all familiar with. And then it's important to understand that when they do these plans, they have the ability to roll these into an individual retirement account or annuity after closing down their business or leaving the company. But to do all this, the plan must follow very specific rules. It has to pass certain tests. They cannot be too selective, and they cannot discriminate in favor of highly compensated employees, though they can provide some selective benefits based on age, and we'll talk about that as well, including the owners of the business. And if a business loses the favored qualification, and it jeopardizes both the employer's tax deduction and the employee's deferral of income. So it's important for us to be aware of that. So as we look at that, we say, what is a qualified plan? And a qualified plan is a plan that refers to whether or not an investment plan offered by an employer qualifies for tax breaks under the Internal Revenue Service guidelines. It must also satisfy the Internal Revenue Service Code in both form and in operation. That's a very important part. And not only the Internal Revenue Service Code, you also have ERISA in the mix as well, the Employment Retirement Security Act, because there are other rules that have to be followed. And that sometimes shocks people when they realize how many rules are really out there. And an individual retirement account is not offered by an employer other than with that exception of a SEP or simple IRA. But it's also important to understand that, again, those are not really qualified retirement plans under IRS code, though they do allow for accumulation of retirement assets in a tax-preferred way. It does not provide all the benefits under a pension or defined contribution plan. Now, as we look at employer-sponsored plans, yes, SEPs and simples are there, but let's look at those versus a defined benefit, defined contribution plan. Both defined benefit and defined contribution plans do fall under the umbrella of qualified retirement plans. They fit under all the IRS and ERISA codes. They have the same ultimate objective of providing retirement incomes and funding for the employers and the employees as well. But now that qualified plan has some specific goals. One, and there's three main tax advantages, is to provide tax reduction, so reduce taxable income by the amount contributed, and retirement savings for the employee and the owners, which is important in today's world, and the account grows tax deferred. So that's important to think about because that tax deferral is critical as people look at it. Now, one of the questions I sometimes get here is, well, Max, isn't it better to put money away on a pre-tax basis because won't people be in a higher tax bracket after retirement? It's interesting. For the more highly comped people, as we've done our studies over the years, Nick and I, we have found consistently that those highly compensated people tend to be in a lower tax bracket after retirement. On the other hand, the average rank and file employee, yes, they may be in a lower tax or higher tax bracket after retirement because they've lost a lot of their deductions because the kids moved out, they paid off the house, those sorts of things. But that highly compensated employee still has enough income that and everything, but they will typically have reduced their income enough that they have gotten rid of things like the Affordable Health Care Act surcharge. Their tax rate may have gone down. They may have moved to a state like Nevada, Florida, Wyoming, some of those where they don't have income taxes. So those two things are important to consider as you plan for that business. Now, let's talk about qualified plans. There are two types of qualified plans, defined contribution and defined benefits. And basically, in those two plans, the fundamental difference in the two types of plans is the defined benefit offers a fixed retirement benefit based on a defined benefit. Defined contribution offers retirement income and accumulation based on a defined contribution. Okay, so that's the big difference there. The plans we're going to spend probably the bulk of our time discussing today, because I think a lot of insurance professionals and financial advisors need to learn more about these, is the fully insured or the 412(e)(3) plan, which is a special type of defined benefit plan. It's fully insured with the guarantee of guaranteed retirement benefits and without all of the market risk. So as we move on, let's talk some more, though, about qualified plans to make sure you have a basis of understanding. In defined contribution plans, there's typically a limit, 25% of compensation, up to a tax for the tax deductible contributions up to the limits defined that given year. And those will change each year. In a defined benefit program, your contribution is defined as how much does it take to provide the maximum benefit, which is $210,000 under current law, where, for example, the defined contributions, going back to that for a minute, the benefits are not limited, but the contribution is limited, for example, in 2015, to $53,000. Now, the contribution is determined as in the defined benefit as whatever amount it takes based on the age, salary, and number of years to retirement to fund a benefit of $210,000 a year starting at age 65 or 62 or normal retirement. Now, they don't have to fund the full $210,000, of course, but if they want to maximize the benefits, that is it. Now, the maximum retirement benefit can start either, we have to design these plans when we do them for permanency, meaning they have to have a funding period of 5 years or to age 62 or age 65 designated as normal retirement, unless the employer fits into a very select group of employers like, say, the NFL. Because as we kind of know, it's hard to last 40 years as a offensive guard for the NFL. So as we get into this, defined contribution plans, basically the participants receive an allocated contribution each year that is usually a percentage of their compensation. It is also put in the plan and the account is credited with a gain or loss each year depending upon the investment return and what they have chosen for their investments. There is a limit each year known as the annual additions limit, or the amount that can be contributed to a participant's account. Under current law, it's the lesser of 100% of a participant's compensation, or $53,000. The employer can deduct up to 25% of payroll plus the employee 401k deferrals. Each participant's compensation is limited currently to $265,000 for that purpose. Now, here's a thought and something to consider. When you're doing a defined contribution plan, for the employee to put in their share, they have some limitations. So, for example, the elective deferrals, as we'll talk about in a minute, is $18,000. Well, to put that elective deferral in, you first have to take that deferral as salary, which means that you have to pay FICA and FUTA taxes, or that 15+%. So there is a load before you can put on that, a tax load of the employment taxes required. And then they have that limit on what they can put in each year, though there are some catch-ups as the client gets a bit older. Here's actually the IRS numbers right now for 2015. We haven't really seen that those are going to increase a lot next year, but they'll give you just some general ideas. Now, it's very important to kind of have a handle on this for a couple of reasons. One is that the annual benefit maximum for a defined benefit plan is $210,000. Number two, it's important to understand the catch-up and the defined contribution annual contribution limit, the annual considered compensation. Another critical thing to understand is who is a highly compensated employee, because highly compensated employees create a whole class of people that can have different benefits and require testing and some other issues to make sure that the plan complies with the rules. Now, as we look at all these rules and the things we've discussed with a defined contribution plan, let's look at kind of how it works. Now, as you can see from this illustration, if you're age 25 and put $10,000 away for 40 years, or until you're 65, you would have put in $400,000. Okay? Now, if we took that same person who's age 55 and so let's put in $10,000 a year till you're age 65, they would only get $100,000 put away, not including any returns on the plan. So really, in a way, it has not favored that older person. And in many, many cases, that business owner has made a mistake because they are the older person, number one, and they have had that false belief that my business is my retirement. And that may not always work out. We just had one client recently, an engineering firm, that they ran into a problem. He thought he had the business sold and the transition and business succession plan was all going well until the young gentleman who was going to buy him out, and literally they were to the point of having all of the paperwork done, all the legal documents done, and everything was going to be signed the following Monday. But the gentleman came in on Friday and said, here's my letter of resignation, and just informing you formally that I'm not going to purchase the business. I have decided to accept a position in Texas. Therefore, I'm going to be moving. And wow, did it blow up his world. And he has found it's hard to find a purchaser for a business that's worth a little over $1 million. And until we started his defined benefit plan, for which he's very thankful now, the business was his primary source of retirement income. That's what he figured is he would sell the business. And it's been worth $1 million for the last 7 or 8 years, according to his CPA. Well, it's worth $1 million if you can find someone who will purchase it for that $1 million. And that's the challenge in today's world. So now, when you get into defined benefit plans, it becomes a different world because a pension benefit is set by the plan formula. So you can have different formulas for each plan. There is no one-size-fits-all. That has to be customized. That annual contribution is the contribution needed each year to provide the stated pension benefit at normal retirement as defined by the plan, which could be 62, 65, or 5 years. All contributions are made by the employer. There is no participant contribution, and there is no dollar limit to the employer's contribution because they can only fund the maximum required for the defined benefit. So it's a different plan. So let's kind of see why that is. Here's another example just like the one we showed you earlier. And in this example, you'll see here's the younger employee. In a defined benefit plan over 40 years, a contribution of $25,000 a year might be made for this employee, and by age 65, they have $1 million of benefit in the benefit pool. Now, the same employee, age 55, though, has 10 years. This employee wants to contribute to have $1 million at retirement. What's the difference? They can put in $100,000 a year, or 4 times the amount that the 25-year-old can put in. Why? Well, frankly, they're a few years older, and they only have 10 years in which to contribute to reach normal retirement. So therefore, they have a favorable contribution limit, which could be very, very beneficial for that business owner who's trying to catch up on retirement because they had a 401k and it became a 201k, or like many professionals, and I am always surprised by this, that you'll see a professional in their mid-50s that only has a couple $100,000 set aside for retirement savings because it took years to go through medical school. It took years to establish themselves in a practice. It took a lot of debt to do all that, perhaps, and they paid it off in their late 40s or mid-40s and maybe spent a couple of years just having a good lifestyle, and suddenly they looked in the mirror and realized there's a lot of silver around the fringes of that hair, or it's getting a little shiny on top. So they've now said to themselves, I've got to figure out how to put more money away, and some of them, if they're professionals, have also realized, I always thought I could sell my practice, but it's not as easy as I once thought from everything I see and hear to sell a practice. So how does a defined benefit plan work? Here's simply how a fully insured defined benefit plan works. The business makes a tax-deductible contribution to the fully insured defined benefit pension plan. That goes into the pension plan trust and that checking account owned by the trust. The trust then, they write the check to purchase the annuities and insurance policies required. At retirement, distributions are made or benefits rolled to another qualified plan. And quite often they are rolled to another qualified plan, meaning a IRA or something like that, perhaps at that time. Some people, though, do choose to have guaranteed retirement income from their pension benefits. Now, how does a fully insured defined benefit plan differ from traditional pension plans? First, the plan, a fully insured plan, is funded with qualifying insurance. What is that? Certain whole life contracts and fixed annuities. Or it could be fixed annuities alone. Now, something that's important to understand, not every company's insurance or annuity contracts will work in these plans. It requires specific features and benefits and cannot have riders with additional costs built in. So that is something really, if you want to understand that, it'd probably be a good time to make a phone call to Nick or myself, and we can certainly cover that with you, because it's not going to be, we're not going to have time to cover it all today. But they also have to guarantee benefits. They cannot have market risk. Now, the plus is there's less compliance risk as well, which is a big thing when you're in the defined benefit world. Now, what's the end result of all that? First, you get a much, much larger current tax deduction for the employer. Secondly, you get guaranteed retirement benefits. Now, what I tell many people is, you know, let's take your 401k, let's take your IRA money that you already have, and let's get a little more risky in that. In fact, if you were to do an asset allocation model, if someone's a moderately aggressive investor, you'd probably find that 24 to 27% of their investment portfolio should be in bonds and fixed investments. Well, instead of having that in their retirement portfolio, they now have a defined benefit pension plan with guaranteed retirement benefits and guaranteed rates of return, which replaces that 24 to 27%, allowing more of that 24 to 27%, or all of it, to be invested much, much more aggressively. And as I always say, that money in your 401k and IRA can then become your go-to-Vegas money, meaning you can be more aggressive in that because you have a permission slip to do that, because you have a pension plan with guaranteed retirement benefits. Now, as we look at all this, let's compare the two types of plans. In a traditional defined benefit plan versus a fully insured plan, they have different features. First, in a traditional plan, you're typically going to have limited early contributions. In a fully insured plan, you will typically have significantly larger contributions in the early years. Here's another feature. A traditional plan could become overfunded or underfunded. Now, what do I mean by that? We had a gentleman call us up a few months ago and said, I need help. I have a plan I've been told by 2 actuaries is overfunded. I need to know how to fix it. And we said, tell us about your plan. Well, he had a defined benefit plan. A few years back, he thought with his infinite wisdom, being a very smart, intelligent professional, he put his money into the stock market. And he did very, very well. But guess what? He's overfunded by $1 million. There are significant penalties as well as significant taxes which can be levied against an overfunded plan. It has to be corrected relatively fast. So even though you have success in the market, you can be penalized in a traditional plan. You could be penalized as well if you were underfunded. Back in 2008, when the market took its big dip, we had clients calling us, and it's a tough thing to have that discussion, to tell the client, you know, your account's down, therefore you're underfunded. So not only do you need to make this year's contribution, but you're underfunded by $88,000. Therefore, we need an additional $88,000 to meet that funding. Now, in a fully insured plan, the beauty is it is always fully funded. It will never be underfunded unless the client does not make contributions as they should. So you don't have that market risk, which is a big plus in today's world, especially with your clients that are not quite as young as they were and willing to take the same risks that they used to. Another thing, with a traditional plan, you must make quarterly contributions to fund the plan. And that requires more actuarial time each quarter to make sure that you know how you should fund the plan based on the market rates of return that quarter. On the other hand, a fully insured plan, funding is extended to the tax filing deadline. That could be the middle of March. It could be September 15th, depending upon whether or not they filed an extension. So instead of dealing with it quarterly and the additional cost of having an actuary involved to calculate what your quarterly funding should be, it happens once a year instead of 4 times a year, and you have more flexibility in terms of how you want to fund the plan and when you fund it. So those are some basic benefits in comparing a fully insured with a traditional defined benefit plan. Now here's a comparison of the actual contributions for the different qualified plans, as you can see here. And we've been talking about how much higher the contributions are and the deductions can be in defined benefit plans. Now let's take a look at how much higher the contributions can be for an older employee in a 412(b)(3) or fully insured plan than virtually any other type of qualified plan. In our example, we can see that the maximum possible contributions and deductions for older employee business owners in the most popular plans is much lower than the comparison of a fully insured plan. And as you can see here, those benefits or those contributions are about 281% more than what they can put into the SEP IRA or the defined contribution plans based on those given ages. And so what you've got here, and if you just were to look at Chris as an example, because he is not an unusual age to get into one of these plans, in Chris's case, he's 60 years old. If Chris did a SEP IRA, he could have a contribution and deduct that for up to $53,000, which is a great amount. But Chris might be happier, and of course, if he's a highly compensated and successful professional or business owner, might very well be, and depending upon his objectives in retirement, he might like to have a defined contribution plan. But on the other hand, if he saw that he could contribute $427,000 and change to a fully insured plan, providing for himself significantly more deductions, he might be much, much happier with that fully insured defined benefit plan. So that's something that you need to pay attention to if you have those highly compensated employees and those who are earning quite a bit more, because contributions could be over 700% higher in the fully insured plan than in the more popular plans offered in the marketplace today. Now, what is the maximum deduction? It's simple. Whatever is necessary to fund the annual benefits for life of $210,000 in 2015 into the plan. Therefore, there is really no maximum contribution, only maximum benefits. So you've got to remember that. And sometimes that's a hard, concept for someone to understand, but in reality, it is there. Now, what's the bottom line for all this? Well, in a way, for each dollar that your client contributes to the fully insured defined benefit plan, the government is going to fund it because of tax savings. And that funding from the government, in essence, could be the 40 to 60 cents of every retirement dollar you're saving through the available tax deduction. And, of course, that will always depend on the individual tax bracket of the client. But that can be a significant benefit for some folks because they recognize if they're making lots of money today because they're working 70 hours a week and busting their pick doing what they're doing and being highly successful, that they cannot do that forever. So what is the opportunity for us as advisors? Well, first, when everybody looks at that, what's the opportunity? Look at tax planning alone. Has anybody looked at the new tax rates? If you're married filing jointly and you're making over $450,000, your marginal tax rate is 39.6. Plus, you've got the Affordable Health Care Act, or what some lovingly refer to as the Obamacare surcharge of 3.8 of the modified adjusted gross income, plus capital gains of up to 20%, and the 3.8% we mentioned above with the Obamacare surcharge. Also, payroll taxes of 15.3%, and perhaps even the 0.9% new payroll tax on higher incomes. Plus, what a lot of people don't recognize is the PEP and Ps, the personal exemption phase out, and Ps, which limits some of the popular and common itemized deductions for high income earners. On top of all that, you've got your state taxes. And wow, look at California, 13.3%. Hawaii, 11%. Nevada, 0%, though. Wow, pretty good deal. South Dakota, none. Texas, none. But we get up to New York, it's 8.2. We look at Wisconsin, 7.75. Oregon, 9.9. Some of those taxes can be significant, and when added on to the higher taxes we talked about earlier, can be put a significant dent into a retirement plan outlook, dealing with how do I accumulate money for retirement when half of it goes into tax coffers. So let's look at how we might deal with some of these issues and how life insurance can work in a fully insured defined benefit pension plan. First of all, life insurance in a defined benefit pension plan can provide for estate liquidity, or something that's becoming very, very popular in today's world because there's a lot of baby boomers. They're nearing retirement. They're looking, how do I transfer this business? They're looking at a succession plan. So part of what it could be used for is the funding of a buy-sell plan. It also provides a very large tax-deductible contribution in premiums. Now, I can tell you this, if we did an all-annuity plan versus a plan with a mixture of insurance contracts, life insurance, whole life, and annuities, we're probably, with the life insurance and annuities, we're going to be able to have about a 15 to 20% greater contribution into that plan than you could with annuities alone. And the interesting part that a lot of folks don't understand is that with that contribution, it will provide the same benefits at retirement. It does not change the benefits. Now, it ensures also the retirement benefits against premature death. In fact, went through an analysis with someone recently and basically said, here's your pension plan, and left to your own devices, how would you handle it? And they explained to me how they would handle it, which is basically to take a survivor benefit, use an annuity, and guarantee the benefits, and then take withdrawal from their 401k and IRAs and Roths. Well, we added the life insurance using the fully insured plan into the factor, and suddenly, because the death benefit existed, they went from a retirement income of about $137,000 to $172,000 because the death benefit at the first death would make up those lost retirement benefits, allowing them to take more money out earlier, and in this particular case, the spouse was younger as well. So it can provide a significant benefit. Now, as we do that, life insurance in a defined benefit plan, you have to remember, does not reduce the retirement benefits. In fact, it has a lower net cost to the insurance benefit since it was purchased with pre-tax dollars. And it increases the contribution and maximizes the tax deduction. It also provides a source of income for loved ones if someone dies early because it does kick in the death benefit and guarantee those pension benefits. Now, does this happen? Absolutely. I believe in the last year alone, we've had 2 death benefits paid out in these plans, and the plans become self-completing in those circumstances. And the economic benefit or cost can be reported to the employee annually if needed and preserve a tax-free status of the death benefit, and there are some things we can help the advisor do there. And the life insurance also can be continued in many cases past retirement as well, which provides substantial benefits as well. Now, life insurance in a fully insured defined benefit plan can be very cost effective because the cost of a $10,000 premium in a retirement plan, because you're using pre-tax dollars, is $10,000. Outside of the retirement plan, that same individual to pay a $10,000 premium probably has to earn $16,000 and change with taxes to net enough to pay the $10,000 in premium. Therefore, this plan provides the opportunity for the client to have a very cost-effective death benefit if that's what they choose. Now, how does all this look? Here's the marginal cost of life insurance in the plan. Here it is, annuity and life insurance only, and you can see here that it is $307,000 and change. Now, if we add life insurance, we get more of a contribution in this case, but it is now all tax deductible. So what's the marginal cost of that? The life insurance premium cost outside the plan would have been $82,000. The life insurance cost inside the plan was $38,000. Last time I did the math, $38,000 was less than $82,000. Therefore, that provided a significant benefit for that male age 62. And looking at a monthly retirement benefit, this is based on the benefits a few years ago, but that does provide for a good benefit. Now, as you look at these plans, the other question I get is, who really should have these and who wants it? Well, I went back and looked at some of the people we've done these with. An independent consultant, age 52, they have W-2 income of $300,000. They want to retire at 62, but yet they do some consulting on the outside. So they have an opportunity. Small businesses with high-earning owners in their mid-50s, with 1 to 4 lower-paid employees, that works. We've got a couple of those. In fact, we have a couple of businesses that are in the healthcare industry providing home health care. So they have large numbers of employees that work less than 1,000 hours a year because they're providing home health care services to senior citizens. But there's a small core of employees who are full-time, and the owner is able to contribute about 87% of all contributions for their benefit. Or another one would be, in today's world, we have a business in a state that has a new booming industry with some recreational pharmaceuticals that help people truly have a different experience. And they have a business with 2 older owners, but with a whole bunch of very, very young employees. So that works very well for them. Now, you can also have the person catching up on retirement. Here's a 52-year-old attorney. He's got a salary of $200,000, significant K-1 income. Currently, they have a 401k profit sharing, and he's able to contribute $51,000 there, but he has to put a whole lot away for his employees. His goal is to retire in 10 years. How can he do it? Well, now with the 412(b)(3) or fully insured plan, we can get a lot more in. Here's kind of how it would work in his particular case. In his case now, here's his 2008 contribution. This is one that was done a few years ago. And you can see here what he would have. In the accumulation in the 401k profit sharing, he'd have about $641,000. In the fully insured defined benefit plan, he'd have $3.3 million and change. And the fully insured plan would guarantee a monthly retirement income of $17,500 a month. Not only did he put more money in, he got a bigger tax deduction, but he also had significantly higher benefits at retirement. Now, who are some other candidates? Doctor, 5 ER doctors, age 48 to 56 with 3 employees, great candidates. 2 endodontists, both age 48, conservative investors with 5 employees, one of which is the daughter of one of the doctors. A CPA firm with 4 partners, age 44 to 62 with 5 employees. Great candidates for the fully insured defined benefit plan. Here's a sample. This is a dentist, age 55. Now, this one was unusual because this employer wanted to provide benefits for the employees as well. But here's a 55-year-old. He plans to retire at 62, currently taking W-2 income of $398,000. He has 3 employees, 28 to 40, earning 35 to 50. So what's the solution? Let's change his W-2 to $210,000. Let's fund a 412(b)(3) defined benefit plan for 7 years for the dentist and his employees. What's the 2013, which is the year this plan went into effect? There's what the employer contributed, $197,800 for himself, saving $75,000 a year in taxes in his situation, accumulating $1.73 million of benefit accumulated and an annual benefit of $143,000, but he was only putting away $34,000 for his employees. Now, he could have done a cross-tested plan with a profit sharing, and there are ways to do that in today's world, especially since PPA 2006. In that Pension Protection Act, they allowed us to combine a profit sharing and DB, which could have reduced this number by about 65%, almost 70%. Now, here's another example to take a look at. Here's a situation where we had a doctor. This was a client in the state of Utah, and you can see here income of $493,000. And currently he was putting his contribution into a 401k profit sharing plan. You can see here what he was doing, the taxes he was paying. So his total taxes were $193,000. Now we come in, we did a 412(b)(3). Now he could have put in more than $205,000, but that's what he could budget for. So we look at what that results in, taxes of $95,000, so almost $100,000 less a year in taxes. And so it saved him significantly. And I mean, which plan would you rather have? Because he avoids all these taxes in doing that. So that was a very, very good plan. Here's one, tucking away second income, 55-year-old college professor. You'd be amazed how many we have like this that have a consulting income, and they're earning $85,000 in salary, and after salary they have $40,000 of consulting income. So they want to put that away and put away as much as they can for retirement. Well, here's how that could work. They take their contributions and they look at the annual contribution they could make by funding the plan, so they accumulate, in this case, $678,000, or a guaranteed retirement income of $3,333, in addition to whatever they were doing through the university at that time. So here's kind of an example that we did for a larger medical group, and we've done these. We've got some urologists, we've got a number of different physicians groups, and this can work very, very well. In fact, probably every year, around 50% of our plans are done on medical practitioners or people in the medical field. Now, here it is. The employer contributions, a straight 401k, 49% went into the accounts of the key employees or those highly compensated physicians. Profit sharing plan, 48% of it went in there. A new comparability plan, 45%. Traditional DB plan, 50%. An integrated plan, 52%. We do a 412(e)(3) with a custom carve-out. We got 93% of all contributions in for the key employees, or in this case, the doctors. Now, if it was your client, which plan is best for that client in this particular situation? And I think you would look at that and say the client would obviously be selecting the higher contribution percentage for themselves. And that is typically what does take place. Now, one of the frequently asked questions, do I have to include everyone? Will my contribution level always remain the same? Who can benefit from a fully insured defined benefit plan? Well, let's talk about those things now. So if we go to that and we say, do I have to include everybody? First of all, part-time employees with less than 1,000 hours per year don't have to be included in the plan. Employees less than 21 years of age don't have to be included in the plan. Employees with less than 1 year of service don't have to be in the plan. And we can structure vesting schedules. We typically do a 6-year vesting schedule that can favor the employees who stay a longer time, which if you have a high turnover, as one of our businesses seems to, that can mean that most of the benefits ultimately are being contributed for the owners of the key employees as well. Now, again, do I have to include everyone? Well, I talked about vesting just for a second there. Employees usually have to stay a minimum number of years with the company to receive full benefits. So what does that mean? Well, they don't become eligible until after they've been there 1 year. Then they're vested based on a 6-year schedule. So 0% the first year, 2% is 20 years. So what that means is if that employer hired somebody January 5th of 2015, they would not be eligible to enroll in the plan until July 1st of 2016. Now, if they've enrolled in the plan, their first contribution with extensions wouldn't have to be until September of 2017. And then the question is, did that employee stay long enough? Okay, now, a vested employee, it's important to understand, cannot lose benefits, even if the employee leaves the job before retiring once they reach vesting. But they can roll that out into an IRA for themselves. Now, will the contributions remain level? No, contributions usually reduce, actually. Interest in excess of the guaranteed rates and dividends in the insurance contracts reduce future contributions. Also, a reduction in salary could reduce the benefits and the contributions. So if a person has a change in their business fortunes, they can reduce their salary, which will reduce contributions and reduce benefits as well. So that's another way that benefits change. Now, how does that look? Well, if you had a traditional plan, contribution levels could look very much like this graph you see here, which is up and down. On the other hand, with a fully insured defined benefit plan, they usually will go down at a pretty steady pace without a lot of change. But contribution levels do go down over time with a fully insured defined benefit plan, though they can go up a little bit at times because benefits are indexed for inflation not every year, but on a regular basis. So, who can benefit from a fully insured defined benefit pension plan? Well, it's based on three key factors: income, age, and the number of years until retirement. So, who benefits? Typically, it's business owners and professionals who are age 45 or older and are within that window of 10 to 15 years of retirement, and have fewer or younger employees that are non-owner employees. Or they may have a special opportunity with highly compensated employees. And if you remember those magical numbers I talked about that the IRS publishes every year, we could go back and review those later. But that would provide some opportunities because you can have a special benefit calculation with highly compensated employees. But also, if there's a desire to contribute as much as possible towards their own retirement on a tax advantage basis, that's usually a driver. And they prefer conservative investments over much more speculative ones, or they may want to take their 401k profit sharing plan and eliminate some of the risk by having a defined benefit plan in addition to those 401k profit sharing IRA plans. So, what do you do to establish a plan? That's usually the next question we get. Establishing a plan, it has to be done in writing before the end of the fiscal or calendar year for which the tax deduction is desired. You know, there's an IRS Form 5500 that must be filed. There's some requirements that way. We work with our clients to help them get the EIN filed, the appropriate pension trust documents signed before the end of the year. We have had several plans that we have actually finished off with the client making their final decision on literally December 31st. We'd rather not have that because it'd be nice to take some time off. And one of our actuaries has kind of moaned because his wife would like to take a cruise during the Christmas season, but that's when we get the busiest. So, let's supercharge your retirement plan. And a fully insured defined benefit plan, they're ideal for select professionals and businesses. They're not for everyone, but for that right business, they work very, very well. They provide a very, very large tax deduction. They can include cost-effective death benefits, disability, and other benefits if needed. So they have some real benefits. So the conclusion for the professional or business owner who'd like to maximize tax deductions and secure a guaranteed retirement income, the fully insured defined benefit plan very well may be the answer because it does provide the maximum tax deductions with guaranteed retirement benefits. So we now have time for questions. So Brendan, I'm going to let you open up the question line, and I hope Nick is now on the line too. So
yeah, Max, I've been there. Thank you. It's been a great presentation. This is Nick Palavita. I'm the adjunct professor for the graduate tax program at Northeastern University. I lead faculty member for retirement plans, and Max did a great presentation on retirement plans, and the insurance industry has some great products. They're insurance and annuity products, which if you open up a trust, a pension trust, contribute assets there and have the trust buy the insurance and annuities, it's tax deductible. If you try to just buy it on your own, it's not. So it's a very favorable retirement plan. I think Max did an excellent job in presenting it, and we want to thank NAIFA for bringing up retirement planning education, which has been my beef in the United States, is that we have 60 million baby boomers, and no one's taken a retirement planning class because I checked all the MBA schools. They don't offer it. JD schools don't offer it. If you go to law school, you don't get it. Even CPAs don't necessarily have to take a retirement planning class. So NAIFA does a great job in offering retirement planning classes so that you're up to date on what you can do with these products, insurance and annuity products, by creating a pension trust and then have the pension trust purchase the annuities and insurance on behalf of the client. So I guess we can open up to questions next.
And just as a reminder, if you'd like to ask a question, please type your question in the question box on the right side of your screen. We do have a number of other questions already. The first question, can any riders, example, DI, WP, QCR, be included on the primary insured?
That's a good question. Unfortunately, no. Currently, and it doesn't make any sense, but as I tell people, ERISA, confusing and don't stay that way. They do not allow those riders to be attached to the whole life contract, and they don't allow anything inside the plan except a whole life contract and a fixed annuity. So you can't even have a universal life contract inside of the plan. Very conservative, but again, this is ERISA, and these are the rules.
Next question, what plan would be best for a restaurant owner with lots of seasonal part-time employees during the summer in a vacation area?
Oh, that's pretty simple, a 2-year eligibility for the restaurant owner. A lot of people think we have 1 year and you're eligible. Well, that is one of the rules, but you can do a 2-year eligibility, although they will be 100% vested if they're there beyond 2 years. But a 2-year eligibility eliminates probably 95% of the restaurant employees because they just won't be there for 2 years. So I would, in a restaurant, create a 2-year eligibility formula in the plan document. And so you hire somebody today, you don't even worry about eligibility for 2 more years.
And our next question, can we get the PowerPoint or slides? And the answer is this webinar is being recorded, and everyone who is registered for the webinar will be emailed a web link that will allow you to access this program in its entirety, both the audio and visual components. The next question, with a tax deduction, doesn't that make the death benefit taxable?
That depends. If you include back in the income the PS58 cost, so let's say that you put a $100,000 life contract and a $100,000 annuity, which is not unusual in our industry. The PS58 cost or the annual term rate may be $4,000. So they get a $200,000 deduction, but they have to include $4,000 in income. So in essence, they only got a $196,000 deduction. Now, why would you go through that confusion? It's now the death benefit can come out tax-free to the net amount at risk, they call it, to the plan participant. It's also known as the PS58 cost or the Table 2001 rate. And a good TPA can help you with that if they want the death benefit to go out tax-free. By the way, there's a couple ways you can contribute to a pension and have the assets go out tax-free. One is once you create the fully insured plan, you die. If you die and you filed your PS58 cost, the death benefits will no longer go out tax-free. Now you've got tax deductions going in, tax-free money coming out. Now notice, though, you have to die. Another way is you can actually establish a 401h account, which allows certain things, medical reasons. In other words, if there's you lose an arm, you're in an accident, et cetera, and you put money in the pension, then the assets can also go out on a tax-free basis, even though you deducted it going in.
The next question, is there a PS58 cost to the employee?
Yes, there's a PS58 cost if they want the death benefit to go out tax-free to the surviving spouse. The cost is what they have to do is include in income some of the annual term rate. Like I said, you get a $200,000 deduction, but your net deduction is only $196 because you had to re-include $4,000 back into income. It's known as a PS58 cost. So it's not really cash going out. It's just your tax deduction went down because you wanted the death benefit to go out on a tax favorable basis.
Are penalties the same for government entities that have underfunded pensions as for private industry?
No, by the way, a great question. And it's been another beef of mine. A government entity can be run underfunded, such as state and municipal corporations, otherwise known as cities like Detroit. A private pension cannot be underfunded, or you're subject to a penalty, and you have to fill out a form, a 5330, and you pay 10% as an excise tax in the amount of underfunding, and if you don't pay the tax, the penalty jumps to 100% of the amount of underfunding. So in pensions, private pensions, which is what we're talking about, are heavily monitored by the IRS, the Department of Labor, and the Pension Benefit Guaranty Corporation to make sure they're structured financially sound basis so these benefits are guaranteed at normal retirement age. Hence, the insurance and annuities, if you use those, Max is right. There's less compliance than if you put a stock in there, because who knows if the stock's going to be worth anything down the road. Look at AIG shrug their shoulders.
Do contributions need to be from only that year's earnings?
Contributions can come from anywhere from the corporations. The corporation can have what they call accumulated earnings, and you can use that to fund the plan. A corporation can actually go borrow the money and then fund the plan. Now, notice the plan can't borrow the money, but the corporation could borrow the money and fund the plan. Actually, General Motors did that one year to the tune of about $16 billion. They went out and borrowed money and used it to fund their pension. So the corporation can have accumulated earnings they could use. They could borrow money and then fund the plan. Oddly enough, I did a whole paper on this area for Social Science Research Network because of the marginal income tax rates and the rates for borrowing. You're actually ahead of the game if you can do so with good favorable rates to go borrow $100,000 at 4%, put it in your plan, and once you put it in your plan, it's deductible and it drops your income. If you're at a 33% marginal tax bracket, you get back $33,000 and you paid $4,000 in interest. But you have to look at it. It's a whole paper on SSRN called Equity Out.
We want to respect everyone's time. We do have a handful more of a few good questions. They're all good questions. And so, Nick and Max, do you mind staying overtime with us for a few more minutes while we wrap up the questions?
I certainly don't mind.
Okay, well, we're going to go ahead and plow through here. How are the EE minimum maximum contribution amounts calculated?
They're actuarially calculated. First of all, many of the employees are not in the pension because of a rule that's been around since 1974 called 401A26. We only need to bring in 40% of the employees in the pension. So most of the employees are in a profit sharing, but because of they call it a gateway rule, the profit sharing has to give the employee 7.5% of pay. Now, how we calculate the benefits for the employees is very similar to the owner, but the owner usually is older and has more compensation, and because of that, the owner gets the vast majority of the contribution, and the employees get very little. Although every one of the cases are different. So this is the importance of what Max went over earlier: the demographics, age, compensation, how long have you been there, and then you submit to what they call a request for proposal, and then the actuaries will run the calculations for you.
A life insurance carrier rep who markets DB plans told me that the IRS does not like fully insured DB plans over those that use life insurance in conjunction with managed investments versus annuities. Is there a special concern for fully insured DB plans?
There was prior to the regulation that came out in 2005. Remember, we've been doing this for more than 15 years in the early 2000s. And from 2001 to 2005, or prior to 2005, insurance companies had these spring cash value policies in the plan, and the IRS didn't like that. Now, we took a position we just weren't going to administer spring cash value policies in our plan, so we didn't have any problems with our friends from the IRS. I did go through a dozen audits, but all successful because we did them according to the rules. I think it's very important, as long as you do this according to the rules. The service is actually in favor of this, oddly enough. As a matter of fact, I had some of my friends at the IRS say, we'd like to actually put a brochure out on this so that more people would actually do fully insured plans as long as they do them properly.
What combination of annuities and life insurance do you usually recommend in these 412E3 plans?
That's another great question. I mean, again, there's rules. The rule is, the major rule is 100 times monthly earnings at normal retirement age, which generates a maximum death benefit of $1,750,000 this year and next year because the COLA adjustments are the same. So $1,750,000 death benefit for a business owner. There's another rule under 74307 called the incidental benefit rule relating to percentage of contribution, where you can contribute up to 50% of the contribution to the whole life and 50% to the annuity. Now, we caution anybody who does that for a couple reasons. Number one, you may, depending on your life policy, have excess death benefits in the plan. What's that? More than enough death benefit that would cover the lifetime income, and you may turn it into what I call an inverted listed transaction. So I would be very, very careful running 50-50. Usually we run, and the other reason you don't run 50-50, if your client needs to make an adjustment next year, they can't. The whole life is fixed, and if you drop the annuity down, you can't drop the whole life down because it's a fixed contribution. So you basically, by year 2, you could throw the administration into non-compliance. Now, if you run 60-40, 60% in annuity, 40% life, then you have rooms to make adjustments, and generally you don't run into what we call the excess death benefit area. But again, a good TPA checks for all that.
And I'm afraid we have time for just one more question. Would this be a good fit for farming and ranching operations looking for tax breaks in good production years?
Oddly enough, we've done farmers and ranchers. I've done several of them in the state of Washington and several in the state of Illinois and Indiana. And part of the reason why is when they have good years, and we did a lot of real estate brokers, when they have good years, it's time to put the money away. When you have bad years, now you have the money in your plan. As a matter of fact, unfortunately, the lady that we did this for in Indiana retired, terminated the plan, and rolled the assets all to her IRA, but she now had accumulated over $250,000 that normally she would not have accumulated as a farmer in Indiana. So yes, the farmers and the ranchers can do it. I had the one in the state of Washington who was contributing $300,000 a year, and now he has several million in this plan. So again, case-by-case basis, but they certainly could do that if they have the cash flow.
Well,
last thing, Brendan, they figure out they can't retire off buying John Deere tractors. Okay.
Well, we continue to have some outstanding questions coming in, but well, we've already gone a bit over time, and we want to respect our members' time. So as you can see up on the PowerPoint slide, we have email and phone information for both Max and Nick. And would you gentlemen mind if our members contacted you with any questions that we weren't able to answer today during the time we had?
Oh, no, my pleasure.
Oh, I
enjoy it. I teach at Northeastern, and I really enjoy this type of work.
Outstanding. Well, excellent presentation. I want to remind everyone that you will be receiving an automated email that will have a web link by which you can access the recorded presentation from today. So I thank our presenters, and also want to thank all of our participants for taking time to be with us today for our webinar. This concludes the NAIFA webinar. Have a great day.
Thank you. Bye-bye.